Welcome to this week's Q&A. We've got a terrific question from a client of ours, a viewer in London this week, and he's asked a question that pertains to many of our clients. He's got a property in Sydney, and it used to be his old home, his principal place of residence. It's rented out, and it's generating him excess income over expenses. So it's generating $52,000 worth of annual income, and this gentleman's paying tax on that. And he said to me, well, look, can I reduce the tax on my Australian rental income by contributing to superannuation? And the answer obviously can be quite long-winded, and we need to consider many different other aspects, but let's just have a look at the basics of this. And first of all, the answer is yes, you can. So rental income is Australian taxable income. If you're a non-resident, an Australian expat living around the world somewhere, it doesn't matter where you're living, because you're going to be taxed on that Australian taxable income at expat rates, at non-resident tax rates. So 32.5% from $1 up to $90,000, and then it scales up. So in this instance, this gentleman's got $52,000 worth of income, and then he has some expenses associated with maintaining that property and paying some interest on a loan, a smaller loan that he still has on this property, and that brings the overall net income down to $27,500. So it's a good sum, because as of 1 July this year, 2021, the maximum deductible contribution that people can make to their superannuation funds is in fact $27,500. It's gone up from $25,000. So what can we do? Well, if we've used up all of our other means of obtaining a tax deduction, this gentleman can make a contribution, a personal deductible contribution into a public office super fund of $27,500. And that would be a pretty tidy outcome, because then there would be no tax to pay on his rental income. There are a couple of nuances to that, because at the end of the day, a superannuation fund has to pay contributions tax, and that's at a rate of 15%. So if we then look at the numbers, if you have a look at these numbers here on the board, originally the tax on his net rental income would have been $8,938. So by contributing the $27,500, that's been wiped out, and there's no income tax to pay. So that's obviously very tax efficient. Then the superannuation fund that the monies were contributed to would pay tax at 15%, which, equivalates to $4,125. But net, after everything's done, you end up with a saving of $4,813. So, that's not a bad outcome just on the prima facie basis of things. Then look at the further benefits, because superannuation funds only pay tax at 15% on income and 10% on capital gain, and if it's an Australian resident fund, which it has to be, you also get the benefits of franking credits on any dividend income that the fund receives. So quite often the rate of tax that the fund pays is very, very low, and as that goes through over the years, people can actually make a substantial saving on paying tax, increase their retirement nest egg for later on, and continue to benefit from the lower rates of tax within the superannuation environment, whether they're an expat or domiciled in Australia. So it's really quite an important issue to look at and to explore if you're in that situation. We have lots of clients that actually are in that situation, because these properties you've left at home are old. So they don't have any depreciation allowances, Division 43 for building costs and Division 40 for fixtures and fittings, to claim those non-cash deductions that we can on new properties. If this gentleman's property had been a new property, he wouldn't have to pay any tax probably, because the non-cash items would have been more than the $27,500 that he was left with as net taxable Australian income. So, lots of things you could look at, but if you've used up all of those legal efficiencies, then superannuation might be a really good way to look at things. But be careful, because many of our clients, talk to me about a self-managed super fund. And if they haven't set one up before they leave Australia, that comes with some pretty inherent problems anyway, which we've discussed in another session. But I would recommend that people contemplating such a move get some professional advice about this. Contact us, and we can sort of give you a pretty good understanding of what you can and can't do in a situation where you are a non-resident already, or even if you are in Australia and seeking to leave Australia and become an expat potentially, what you might be able to do with your existing self-managed super fund. So if you like what you see here, please subscribe to our YouTube channel and click like, and I look forward to more interesting questions for next week's topic, and look forward to seeing you then. I'm Andrew Unterweger from Wise Guru.